Good day, ladies and gentlemen. My name is Peter Tirschwell, Vice President in the Maritime and Trade Division of IHS Markit, and I lead the Journal of Commerce. It is my great pleasure today to participate with you in the Xeneta event, and I appreciate the opportunity and the invitation to speak with you for approximately 12 to 15 minutes. I bring you greetings from rural Maine in the USA, where my family and I have been hunkered down since May. Today, it is my pleasure to have the opportunity to share a few thoughts with you about the current, and I would say rather unique and extraordinary container shipping environment that we are all now in the middle of, and especially about what it could very well mean for the future, starting in 2021, but well beyond that as well. My own view from covering this market for many years as a JOC journalist and for leading the TPM program is that, like it or not, we have most likely arrived at a turning point in the container shipping market, and that as a result of this, the future is going to look very different from how it has looked in the past. The change is going to have ramifications in particular for those on the buy side of container shipping, who are obviously the shippers or BCOs, in other words, many of you who are participating in this event today. In recent years, we have seen hints, actually more than hints, plenty of evidence, in fact, that this market was leaving the post-financial crisis years behind and headed in a very different direction. We've seen, for example, a greatly accelerated pace of consolidation that essentially reduced the number of major east-west carriers by half. We had seen the order book steadily decline to record lows. We started a few years ago to experience something called blank sailings. But as the pandemic hit this year, what was a transformation literally years in the making materialized or took flight in the form of ocean carrier actions and behaviors long assumed to be well beyond their reach. We're talking about things like discipline on rates, ability to rapidly adjust capacity, achieving profitability amid a deep global recession, and even the ability to introduce and charge for premium services. This is all new. As it turned out, the past several years of carrier consolidation, restraint in vessel ordering, and what I would describe as a coming of age of alliances as agile operating entities. And those alliances incorporating all the major carriers. All of that had prepared the carriers for a moment no one saw coming, obviously a once-in-a-century global pandemic and the supply and demand side shocks and profound societal changes that resulted. As the investment bank Jefferies stated on September 29th, roughly 2 weeks ago, regarding the carrier industry globally, quote, "The stars are aligning for container shipping, historic consolidation, rational capacity management, and now a fast bounce back in post-lockdown demand." How long ago does the introduction of the Maersk Triple E ships seem now? How many times over the years did my JOC colleagues and I quote carrier executives saying things like, "We're stupid," or "We can't get out of our own way," when one GRI after another would disappear into thin air, and with it any sense of confidence and belief that pricing discipline could ever be possible? I'll tell you, you hear that type of thing from carriers a lot less frequently today. The question becomes, what does this mean for customers? What does it mean for supply chains? And what does it mean overall going forward? The way I look at it, things could really go in a couple of different ways. In one way, if this is all a story about carriers exercising newfound market power to drive up pricing, it's actually not very interesting. It would make the industry more argumentative, more transactional, and it would result in regulatory pushback, as we started to see this year, with the result that people like me would be spending our time writing stories about the EU reviewing liner shipping consortia. Frankly, there are more interesting topics out there. And if it went this way, it would basically be a continuation of the story of the past decade, which is largely one of carriers acting on their own behalf to deal with their own problems, rather than doing what most businesses try to do, which is to try to find ways to create value for their customers. And 3 examples of this stand out very clearly. Slow steaming. Container ships operating 25% slower than they did a decade ago. That helped carriers by cutting their fuel bill and absorbing excess capacity in a period of overcapacity. But for shippers, it slowed down the supply chain, increased overall lead times. It was not good for shippers. Similarly, take the Take the construction of these gargantuan megaships, starting with the aforementioned Triple E ships in 2011, which I get it, reduced per unit costs for carriers, but which also slowed down shippers' supply chain because of the days on end that it takes to unload these behemoths and the fact that they typically call it fewer ports and not necessarily the best ones for shipper supply chains. And finally, there is consolidation itself, which enables a carrier to take out cost, but leaves the shipper with less choice. So don't get me wrong, I do think part of the story going forward will be carriers exercising newfound market power. There is a real possibility, for example, that the record rate levels now seen in the Trans-Pacific trade due to a continuing strong bounce back in demand, combined with carriers' ability to flex capacity in the short term, that will carry over into 2021 and lead to a different contracting season versus the last one in 2020, which occurred during the depths of the lockdown. The comments on LinkedIn from the Vanguard head of the FCL business, Stephanie Loomis, and you can find them right there on LinkedIn, are quite interesting in this regard. She said, and I quote, "I would be warning my CEO now that things are going to change." And one should not doubt the carriers' focus on acting on their own behalf. Carriers, we should not forget, are in many cases enjoy various forms of state support, but at the end of the day, they are profit-making enterprises answerable to shareholders. And they are still not where they want to be profit-wise. If you were to look at return on invested capital of publicly traded carrier companies like Maersk or Hapag-Lloyd, they have gone up over the past year and will go up again this year. But in both cases, they will be no higher than roughly 6%, which is still below their cost of capital. And if we were to look at over the 20 years from 1995 to 2016, the average return on invested capital for container carriers was only 2.6% against a cost of capital of nearly 9%. That's according to McKinsey. And I mention this only to say that I believe there to be a great deal of pent-up frustration on the part of carrier organizations when they see year after year themselves investing in and providing the capacity without which cargo and trade would not move and not really making money, while others such as freight forwarders or marine terminals or railroads or other participants in the supply chain are the ones who are reaping the profits from container shipping. You might say that the underlying tension that exists between certain carrier organizations and the forwarding industry is tied to this very fact. But then again, if this industry is famous for anything, it's long memories. If you were to ask carrier executives if things have really changed, and I have asked them, you would find a lot of caution. Many are not ready to declare that we have entered into a new era in terms of market power shifting to carriers. But even that may be changing. Last week, I moderated a webinar that included Vincent Clerk of Maersk and Otto Schott of Kuehne+Nagel, in other words, the heads of the largest ocean carrier and the largest ocean forwarder, respectively, as well as the indomitable Alan Murphy of Sea Intelligence. And the last question I asked them was interesting. It was to give me a one-word answer, temporary or permanent, to the question of whether carriers' newfound capacity management skills would endure. And without any hesitation, all three said permanent. So let's imagine for a moment what a different scenario could look like. That could be a scenario in which carriers seek to create value for their customers, and where at least part of their compensation is derived from creating value versus blunt force market power. And a good place to start that discussion is by looking at what shippers need from carriers going forward. For example, we saw very clearly during the pandemic the explosion of growth in e-commerce, which by its very nature places greater demands on the supply chain for timeliness, accuracy, and accessibility of information and data to drive decision-making often in real time. And it's not just e-commerce platforms like Amazon or Walmart that are demanding an end-to-end digital experience. It's also industrial shippers. Maybe many of you on this call today, chemical companies, energy companies, agribusiness. It doesn't matter what kind of shipper you are increasingly demanding an end-to-end digital shipping and logistics experience that container carriers potentially are able to support you in. And this gets to another aspect of where things could be headed, which is carriers being able to offer specialized or enhanced services for a fee. Is the market moving in this direction? In prior years, efforts by carriers to introduce and be paid for value-added services would typically disappear in the undertow of overcapacity and the absence of rate discipline. Some of you may recall the APL Ocean 53-foot container being just one example. The daily Maersk, daily sailings out of China would be another example. But now carriers are introducing products or offerings like last on, first off options, faster services modeled off the expedited Matson service in the Trans-Pacific, capacity availability based on seasonality. And while these services, for the most part, are largely still in their infancy, they are not being dismissed or rejected as easily as they would have been in an earlier day. Think about the concept of mutual contractual commitments, bizarrely uncommon in container shipping, which is beginning to take hold as the recent growth of the contracting platform NYSHEX is showing. Some carriers like Maersk are trying to take this concept to an entirely new level in building out an end-to-end integrated logistics offering, literally pushing the boundaries of a traditional container shipping business. But behind the scenes, you are increasingly seeing the other carriers go down this road as well, maybe in more subtle ways. So to wrap this up, in my view, we're clearly at an inflection point of some kind in this market. I think there's no question about that. Everything we've seen in this historic pandemic year of 2020 points in that direction. The real question is where things actually will go from here. Again, I personally think, and I'm really interested to hear what you guys think, we're going to see a combination of greater market power by carriers, but more value creation in the supply chain, which can't come soon enough, given that this is exactly what shippers increasingly need. Now, it may be that not everyone agrees with what I've said here today, but I am interested in hearing from you, and I'm looking forward to carrying on the conversation.